So first, thanks for putting on the program, Luis and Annette. My co-author Yanan is here as well. So let me tell you a little bit about what we're trying to do in this paper, although it's I have the wrong one here. It's not advancing. That works. Got it. Thanks, Annette. As usual, Annette's bailing me out. All right, so we're interested in looking at the economic benefits of predicting individual stock trading volume. All right, but the way we're going to do it is we're going to recast the volume prediction problem into a portfolio problem. And by doing that, we actually end up, once we understand what the economic loss function is, we can actually improve upon our predictability. And I'll explain what we mean by that in just a second. First of all, where we started with this, or one way to think about it, is most of the research in asset pricing is about predicting different moments of the returns. Mostly it's the first moment, then followed by the second, and sometimes beyond that. But there may be non-return related variables that are interesting for asset pricing. It's just how do you quantify those, or how do you assess their economic importance? And this might be important, particularly because we've spent so much time predicting mean returns that there's a lot of evidence out there that there's diminishing returns to doing that, right? We see that out of sample, these things may not have worked as well, either from overfitting or from arbitrage activity. So we're going to take a look at one non-return variable here, trading volume. There's lots of others that one could look at, but the question is, how do you assess what's a good predictive value other than just statistically in an economic sense? And so I'm going to try to connect trading volume predictability to making better investment decisions. And I'm going to do it through a very simple model, okay? So first, we're going to find that trading volume is actually highly predictable, probably easier to predict than returns for sure. I'm going to then connect it through some economics of the portfolio problem using this concept of participation rate through a very, very simple trading cost model, and essentially translating the volume prediction problem into something we might care about economically. And we think this could be an interesting frontier for portfolio research, but really just the beginning of that. Okay, there's a lot more to do. So here's a simple way to think about it. If we think about most trading cost models, most transaction cost models, the biggest one that a large trader faces is their price impact, which is essentially how much you're trading relative to how much everyone else is trading at the same time in the same direction. Kyle's Lambda was the most famous version of this. But if you think of participation rate, it's roughly how much you're trading relative to how much is being traded in the market at the same time. And the numerator of that is investor specific, right? And you often need proprietary data, like some papers that I've written with some of the AQR data, but the denominator is widely available, right? Dollar volume that's out there. And the basic idea is holding the numerator fixed, of course. If volume increases, price impact goes down, and you could trade more aggressively. Of course, vice versa if you get the opposite effects. And that can result in better implementation. Now, importantly, I'm not trying to estimate the best T-cost model here. This is going to be, not a very good T-cost model because I'm only looking at one variable, the dollar traded volume in the market. Okay, so it's purposely simple for a couple of reasons. One is volume's generic. It doesn't rely on a specific trader. It's exogenous. My impact on total dollar trading volume, even as a large investor, would still be tiny, and purposely simple. Okay, it's widely available data that anybody can use. All right. So what we're going to do is combine forecasting that volume measure, translating it through a financial model to something economic, and then creating net of cost alpha from that. Okay. So let's start from a statistical perspective. Okay, and then we'll get into the portfolio optimization, and then do some trading experiments to see what the impact would be. So this is the data, 5 years of data, daily data in every stock. We'll have a training sample and out of sample test period. I'm going to skip over those details. We're going to use a number of different predictors to predict trading volume, ranging from simple technical signals people use, the whole zoo of factor characteristics that have been used to predict returns. They may or may not have any impact on volume, but we can throw those in there, as well as calendar events like triple witching days and earnings announcement events, things of that nature. Okay. Volume, as you might expect, the level of volume is highly predictable, like prices, right? Pretty stable. But changes in volume is the object we're going to focus on. And our benchmark is going to be a very simple moving 5-day average of volume. So we're going to look at the difference, eta here, between what trading volume is today relative to an average over the last 5 days, kind of like predicting changes in prices. And you can see how the distributions look different there. All right, so as a first pass, let's start with just looking at the out-of-sample R squared. And we're going to use a couple of different, as I said, on the columns here, you've got different characteristics that we're using to predict volume. The rows represent different methods. There's the MA5 as the benchmark, that's the moving average. You've got just OLS, a neural net, and a recursive neural net, which is looking for nonlinearities in the predictive variables, how they predict volume. Recursive just allows for dynamics in those variables as well. And you can see how the number of parameters that gets estimated grows depending on the model. But one thing you see in terms of the out-of-sample R squared is that as you move from left to right, as you use more predictive variables, you get better out-of-sample performance in terms of predictability. And as we use a more complicated model, we get better out-of-sample predictability as well. That's the virtue of complexity, but now applied to volume here instead of returns. Okay? As a sanity check here, if we split up this predictability for the smallest versus the largest stocks, it goes in the direction you would expect, which is as you go from nano stocks to mega cap stocks, we can predict changes in volume much better. And of course, it still holds true that the more complicated, the more complex the model, the better out-of-sample predictability we get. This is all relative to just a simple moving average. So this is the improvement in out-of-sample R squared relative to the simple moving average. Okay, now that's all well and good, right? We can predict volume, but what does it matter? How do we quantify this in terms of economics? So what we're going to do is build a really simple model here where we're going to trade off the cost of trading, which is exactly what it sounds like, versus the opportunity cost of not trading. Okay, so as a really simple example here, think of X0 as this is the current position I hold. So if I trade, whether I sell some or buy some, I'm going to incur a trading cost, which we're modeling here very simply as a quadratic function, right? So, and it's symmetric. Now, X star is the optimal portfolio weight I'd like to trade to based on new information, based on my alpha model. And so obviously I'd like to trade all the way over to here, but I'm worried about what trading costs I'm going to incur if I trade all the way out here. Of course, balancing that is the fact that I know if I don't trade all the way to X star, I'm going to incur tracking error, which we also model quadratically, just using a simple mean variance utility function. And so where I'm going to trade is going to be essentially where these two things cross, right? Balancing how much I want to get to the optimal weight versus how much trading costs I'm willing to incur. And Z is going to represent a fraction between X0 and X star going from 0 to 1. It's the ratio of those two things, how close I'm going to trade to the optimal way absent trading costs versus how much am I just not going to want to trade at all. Now, if I look at a security, suppose the security that I'm trading in is less liquid, meaning that my price impact per dollar traded is even higher, then I'd get that red curve, right? Still quadratic, but it's got much steeper slopes. And you can see here, I would trade much closer to X0 than to X star because now trading costs have become, more important in some sense. They're bigger, and the opportunity cost has not changed, right? Because whether the stock is liquid or illiquid, we're going to assume that doesn't affect the alpha model. It does, of course, affect price impact, and that's the idea. So we're going to do this for every single stock. Okay. So the details of this is tracking error. Okay. So tracking error is just going to be represented by this quadratic function, right? Mu is just a parameter that represents how much you care about that tracking error. If you're really risk averse, you'll care about it more. And mu is proportional to risk aversion as well as your assets under management. So if I'm a large firm, I'm going to care about mu even more. Why? Because my price impact is going to be bigger as well. So it's going to work in both directions. All right. And then trading costs, we're going to model very, very simply from the literature. We're going to use a simple price impact function. In fact, I have papers that say it should be more complicated than this, but this is just a really simple way to implement this, where it's just going to be 0.1 times the participation rate, which is just a function of volume, okay, which is in the denominator there. And volume is the object that we're trying to predict. All right. So if we put all that together, We're going to try to minimize the expected economic loss, which is a combination of the cost we incur from trading versus the opportunity cost of not trading, the tracking error we're willing to incur, and solve for that for each position in the portfolio, and choose a trade Z, which is just a proportion of how closely we trade to the optimal weight versus how much we don't trade at all, 0 to 1. All right. As a simple example here, let's suppose we knew what volume was going to be for sure. We didn't have to predict it. I know what tomorrow's volume is going to be. Then the curve might look something like this. The optimal policy, if I know what V is for sure, is in a range here where my price impact is likely to be very large because volume is very small. I'm not going to trade at all. And then at some point, as volume becomes big enough, I start trading and getting closer and closer to 1. Notice the y-axis here is how much I don't trade versus how much I trade to the full target. And you can see what that curve would look like. And that's if I know what volume is for sure. Okay? And this is the distribution of trading volume across the stocks. The dotted line here is if I increase my aversion to tracking error, obviously everything shifts a little bit to the left. I'm going to trade a little bit more aggressively, a little bit sooner as volume increases. Okay. But the problem is we don't know what V is, right? We have to predict V. So we actually want to turn V hat into a portfolio decision Z. I want to know, how do I translate my prediction for volume tomorrow into a trading decision, into Z, for how close I should get to the target trade? Okay. So there's 2 ways to do this. The classic way is to solve this in 2 steps. First, minimize the statistical error of your volume prediction using something like MSE, mean squared error, and then take that optimal prediction for tomorrow's volume and plug it into the portfolio problem and calculate the economic loss. Okay, that's one way to do it. A second approach, though, and the one that we're going to show you has some benefits to it, is to actually minimize the economic loss. And what you're going to do by doing that is what this optimization is going to solve. It's going to solve for Z, but there's a 1-to-1 mapping between Z and V, right? Z is going to imply what your volume prediction would be to minimize that economic loss. And that's going to turn out to be a better predictor out of sample, okay? So let's take a look. I think it's worth spending time on this picture, even if I run out of time. On the left here is what we have if we have a statistical loss function, okay? So let's take mean squared error. So I have volume at different levels. Here's low volume, here's high volume. The dots here represent if I knew what volume was going to be tomorrow for sure. That's the optimal policy, right? So if I'm off a little bit, if I underestimate it or overestimate it, I incur some statistical error, right? It's symmetric. And you can see that at every level, all right? And that's what solving for the lowest mean square error will do. Now, over on the right here is if I change the y-axis from statistical error to an economic loss. Instead of statistical loss, let's think about the economic loss. And the economic loss is driven by this trade-off between tracking error and price impact. Now, notice at low volume, okay, you can see here that if I think the volume is going to be about here, but it's actually way over here, this blue line, okay, when the volume is truly low, but I think it's higher than it is, it's very costly. I end up trading over here aggressively, incurring huge price impact costs, even though I wouldn't have wanted to trade at all because the volume should have been low. Conversely, if the volume is actually high and I overestimate it, there's no consequences to that, or very little, right? It's pretty flat here. And if I underestimate it, there's an opportunity cost here, but it's bounded, right? It's bounded by 0. And so if you look at this at different levels of volume, low to high, you can see that there's an asymmetry here, which is overestimating volume when it's actually low is incredibly costly. Underestimating volume when it's actually high is less costly. And then you got the flip side of both of those things. When the optimization or the prediction problem can take that into account, it doesn't want to minimize mean squared error anymore. It wants to minimize that economic loss. It's going to take that asymmetry into account. And that's going to be better for creating portfolio decisions. So in fact, what the optimizer is going to do, it's going to be very conservative and not want to overestimate volume. And it's going to be a bit more liberal at underestimating. It's not going to be as big a deal for most of the distribution that you see with the stocks. Okay, so now let's take that and let's actually apply it to some portfolios. First, some hypothetical ones, and then some factors that we look at in the literature. Let's start with just this idea of economic learning versus statistical learning. We're going to look at three different fund sizes here, 100 million, 1 billion, and 10 billion. Because remember, AUM matters, because the larger the AUM, the smaller the mu, the more you're not going to worry about tracking error as much. Okay. So, and we're also going to look at the different neural networks here. These are neural networks that are using a statistical loss function. And when it says econ, they're using the economic loss function. And what you see is that there's, take a look at this middle column here for a billion. You can see here that the economic loss function is actually going to incur more mean squared error relative to the baseline, okay, of just a moving average, but it's going to produce better out of sample performance in terms of what we care about, which is the portfolio decision, okay? And you can see that over here. The economic loss is being minimized, right? But it's incurring more statistical loss in the process, okay? So you're willing to sacrifice those. All right, so let's apply this now to a couple of trading strategies. The first is we're going to use a hypothetical trading strategy which has an extremely high Sharpe ratio. It's a cheating strategy. We give ourselves a 1% chance of knowing whether the price will go up or down tomorrow. Okay, so you can create a 7 Sharpe ratio on that. But the reason we do this is the turnover is incredibly high. So price impact costs would be very, very large with that. All right. And then we're going to apply it to the factor zoo, to the Jensen, Kelly, and Pedersen factors that look at about 153 characteristic sorted portfolios. All right. And then we're going to track these investments outcomes out of sample. So first, with this unrealistically high before cost Sharpe ratio portfolio, where with a 1% chance I can predict whether the price will go up or down tomorrow on an individual stock, it's a Sharpe ratio of about 7, okay? But at any decent size AUM, price impact cost would wipe this out, right? So what if I ran it through this portfolio optimization where I tell it what volume's likely to be tomorrow based on either a moving average or going all the way to the recursive neural net with an economic objective and say, given that, how much would you trade this portfolio and to what extent to the target weights, taking that volume prediction into account? And you can see here at the various fund sizes, basically, as you move to the more complicated models, and especially if you use an economic objective, you're getting much better out of sample performance, both in mean returns as well as Sharpe ratio by doing that. So notice, even just using a moving average, an MA5 of volume, that 7 Sharpe ratio goes down to a 2, right? But you can get it up to about 2.5 using the recursive neural net with an econ objective. Oh, and I should mention Oracle. Oracle is if I cheat and say I know what volume will be tomorrow. Okay, that's the best I could do, right? So that would be, a 3 Sharpe ratio to a $10 billion fund, or about 5 or 6 at 100 million. Okay. Now let's do the same thing, but with the factor portfolios from JKP, right, that are in the literature. So on the y-axis here, I've got the mean return gain using, and we're just going to use here the recursive neural net with the economic objective versus using a moving average of volume, a very simple forecast of tomorrow's volume. And on the x-axis is the turnover of each of these factors, okay? And you can see here, it's kind of intuitive, right? The factors that have much more trading activity and therefore trading is more important. And of course, that means price impact is more of a concern. You get a much bigger benefit out of forecasting volume and forecasting it more precisely than you do for the lower turnover strategies, okay? And as we show in the paper, that's true for the recursive neural net versus the simpler models and using more variables. And it's particularly true if you use an economic loss function as opposed to a statistical one out of sample. Am I doing on time? Because I'm almost done.
20 seconds.
Oh, perfect. All right. So, and then if we summarize it, there's a lot to look at here. You can't read what those factors are, but if you summarize into groups, into the clusters that JKP use, you can see that short-term reversals is all the way to the right, momentum and seasonality kind of in the middle. They are higher turnover strategies, things like size, and value much closer to the left. So it's sort of what you would expect from all this. So just to wrap up, machine learning can be very effective, not just predicting returns, but also stock level trading volume. We're using a simple translation to translate that into a portfolio problem where we can gauge the economic benefits. One outcome of doing that is then you can change the predictive loss function to get even better results when you look at what the costs and benefits are of predicting that volume. And that's just one application. All right, I'll stop there. Thanks.